let's discuss the price to earnings ratio and or the what they call the PE ratio for short, and EPS or earnings per share. So first of all, big picture, PE ratio just tells you how much, if a company's overvalued or undervalued. And, generally growth stocks are going to have higher PE ratios, which basically means that people are willing to pay more for future earnings. So you're paying upfront for a certain number of earnings, but you're expecting that earnings to grow versus value companies, which are going to be more established, or blue chip companies. They're going to be lower, generally speaking, right? And there's an average per industry. Obviously, if it's going to be biotech, it might be a little bit higher, or technology versus, if it's something that's like an industrial company, might be a little bit lower. So it's very important when it comes to fundamental analysis. And basically, it's going to be computed by the market price of the stock per share divided by the earnings per share, right? So let's unpack earnings per share. Earnings per share is going to be net income, which is total revenue minus total expenses. Total revenue, what you earned, minus total expenses, what you spent earning it. Net income minus preferred dividends divided by outstanding shares. The reason why you take out the preferred dividends is because that income is not available for common shareholder. That income is reserved for preferred shareholders. So you want to only take into account the one that's reserved for the common shareholders. Divided by shares outstanding, which is the total number of shares out there. Remember, there's like issued, authorized, that kind of stuff. I'll talk about that in another video, but outstanding, the ones that are in the hands of shareholders. That's not going to include treasury stock, which is company purchasing back their own stock, right? So that would be what's called basic EPS. Then there's also something called diluted EPS. Diluted EPS. So when it comes to, first of all, let's just start out with this. There's certain things that are dilutive. There's some things that are not dilutive. So, for example, rights for stock are not dilutive, right? A right is basically, the whole purpose of it is just to avoid getting diluted out. So, if company issues more shares, you get the right to buy those shares at a discounted price relative to the market. They usually have a short maturity. Stock dividends, stock splits, reverse stock split are also non-dilutive. It's really just an accounting trick. It's not really like you're not really generating any value or anything like that. Now, when it comes to convertible bonds, convertible preferred stock, warrants, which are like long-term options, usually issued together with a bond to make it more sellable, incentive stock options, non-qualified stock options, all those things will be dilutive. So when it comes to diluted EPS, you would consider the shares outstanding as if all the shares were converted, right? If everybody converted their bonds, if everybody converted their preferred stock, if everybody used their ISOs and NSOs and warrants, right? If everybody converted, right? So that probably means that the stock shot way up. Obviously, that's going to affect it. So just to kind of reiterate it, PE ratio, good for fundamental analysis, tells you how much people are willing to pay right now for earnings of the company. If it's a high PE ratio, it could be just overvalued, or it could be the fact that the expectation is the company's going to grow a ton in the future, right? Like something like NVIDIA, right? PE ratio is going to be market price divided by earnings per share. So market price per share divided by earnings per share. Earnings per share is going to be total revenue minus total. Earnings per share is going to be net income, which is total revenues minus total expenses minus the preferred dividends, right? Because can't count that. Divided by shares outstanding. Shares outstanding could be either just the current outstanding shares or what the outstanding shares would be if all the dilutive, all the dilutive things out there, like, convertibles and warrants would actually be exercised and would cause the stock to be diluted. So I hope that makes sense and hope you have a great day.